Happy weekend, everyone. I hope you're all doing amazingly well and relaxing after a fruitful trading week. John Henry here, SSFTG. Welcome to the week in review in the U.S. markets. In this, we take some time out to look at a technical overview of the markets and what to expect as we move into the next week. If this is your first time on the channel, welcome, my friend. I hope to earn your like and subscription today. All right, over to the news calendar for the week. We can see, obviously, Monday, tomorrow, going into the 21st, is a holiday. The markets and banks will be closed that day. Along with that, there are some news announcements with FOMC member Bowman speaking at 11:15, but for the most part, Monday is going to be a non-issue. On Tuesday, we have the S&P Case-Shiller HPI composite. That's all coming out at 9 o'clock. The forecast for that is 18.2%. At 9:45, we have the manufacturing PMI. The forecast is 56. Market composite PMI at 9:45 as well. The previous is 51.1. And services PMI forecast is 53. CB consumer confidence is the only large news announcement that we have going into Tuesday, and that is expected to be at 109.8. The previous 113.8. Wednesday does have some news, but it's not the one that you would expect. Because Monday was a holiday, we don't have inventories for crude oil on Wednesday. Instead, we have the API report coming out on Wednesday at 16:30. Everything is bumped off of day, but that's it. That's the only news announcement for Wednesday. Pretty calm and quiet. Thursday, however, gives us a bit more to work with. Geez, everything starts slamming in on Thursday. First off, the 8:30 news announcement with GDP forecast is 7%. The previous was 6.9%. We also have the initial jobless claims forecasted 235,000, previous 248. And then the new home sales at 10 o'clock. New home sales are forecasted at 807,000. The previous was 811. And because Monday was a holiday and everything got pushed off, we have crude oil inventories at 11 o'clock. On Thursday, the previous was 1.121 million, but until we get a little bit further in the week, we won't really know what the forecast is, and the API will at least give us something to have a heads up with. As we go in later in the morning there, or, well, I guess lunchtime into afternoon, we've got FOMC member Mester speaking, and then Fed Waller speaking later at 8 p.m. And then finally, Friday, the brick wall of news that Friday is. Not really a ton of big news, but there are some announcements that we have to keep our eyes on. 8:30 has the core durable goods orders. The forecast is 0.4%, previous is 0.6. We do also have some other 8:30 news, but the big one is the core durable goods orders. We go a little bit later in the day at 10 o'clock. Among some of the other announcements, pending home sales is going to be the big one. Forecast is 0.5% in the positive. Previous was negative 3.8%. We do also have tentatively the Fed monetary policy reports, which are going to make the markets go probably absolutely crazy. It's going to be a little bit of a wacky Friday, that's for sure. We're going to have to be on our guard. Looking at last week on the Nasdaq in terms of what we are anticipating, the Nasdaq had a resistance zone up in the 15,311s, didn't even come close. We did end up getting those three lower highs, which is still very much a concern. We'll get into that in a little bit here, but the zone of support in the 14,215s to 090s worked out really, really nicely for a good rejection. Didn't make it all the way up towards the highs, though. Couldn't even make it up towards the primary objective, getting back to 15,000 or even just the wedge high, and rolled all the way back down again, further kind of confirming a possibility of a down channel. Let's update this, though. All right, there we go. After getting a couple updates on the chart, we can see that for the most part, some things don't change, like the bear channel and all of that maintains its downward pressure. The resistance at the highs is maintaining its pressure. Those things aren't necessarily changing, but what is changing is the fact that we're seeing the sellers step up aggressively without getting any relief rallies for the earlier buyers who may be stuck to get out, sellers who missed the move down to get in. Regardless of the way that you want to look at it, we haven't had that relief rally yet. And given the fact that we're already back down towards near the lows, there's a few different ways that the market's likely going to want to try to play ball here. We've got the aggressive sellers, which are going to be hanging out at around the 14,386s. Effectively looking at the previous zone where they tried to break up, failing, continuation back down, breakout pullback style, back down into the floor. It could go a little bit further up, though, in terms of how aggressive they want to play, because we are coming off the lows of the channel. And if the market can work its way a little bit further forward, we might have a nice little lineup of a channel and horizontal resistance, which would be beautiful around those 14,603s. Now, depending on how the market wants to play ball, if it does want to push through these, we have follow-up less aggressive. You can call these like the medium aggressors, sitting at around the 14,820s to 930s. But if it doesn't hold off there and the sellers can't get the job done, then we're probably going up to that larger one that's been sitting there and waiting since last week. Unfortunately for the bulls, they really don't have a whole lot to work with. I mean, we'd have to go out to like a daily chart to find anything in terms of support, and we really then don't have anything until like 13,000. It's not looking good for the bulls. Looking at the S&P from last week, we can see that a lot of things kind of played ball here and kind of a little bit of a funky way. We do know that the S&P did have some extra bullishness in it based on the larger time frames, but the resistance was also pressing down on, and we were getting this kind of wedge formation. We had support resting at the 43.94 halves, which did work out beautifully, although it did churn through it a little bit first. In the end, we did end up rallying back up towards the resistance zone at 44.67 half, where we finally dropped all the way back down into that beautiful bounce support right at the end of the week. 43.34 down to 43.03. That might not necessarily be done. Again, the bears are in control, but we've got to modify this a bit more now that we have some more information. There we go. Good and updated here. As far as the S&P is concerned, the zone of support doesn't change. That still stays put from the 4330s to 4300s basically. That whole area is going to be where the previous sellers, and we're talking the sellers that are back here on the 26th, got stuck, and they're going to be looking for a way to exit in reverse. Now, in terms of the overall continuation to the downside, if the sellers are able to break through those 4300s, they've got a really good shot at cracking the lows, breaking through the base, maybe even challenging back down towards those 4000s. They've just got to get these support buyers out of the way. It definitely is not going to be very easy considering that they have channel support and all this other stuff going on, but if the market is able to get a little bit of a corrective phase back, we've got the first zone of resistance that stacks up back in the 44.14s, in the 44.20s in that area, basically back at those previous swing highs, swing lows, congestion points, looking to reverse the market back down to re-challenge. And even if we do bounce off of it, we could just end up doing something like this until we eventually find a structural combination point where they all come together and they can work towards helping each other fall apart, in this case, back towards the downside. If the market does break above the channel, then they might be in store for a reversal. They might actually have some gumption to get going back up there towards that higher band of resistance in the 45.80s to 46.20s. Last week, we were looking at how the Dow was possibly turning into a megaphone. And, at the time, that was the only swing low that we had. Now we can modify this out a little bit further, and it gives us a very, very nice culmination point. The zone of support down here really doesn't change too much. We can push that a little bit further forward because that's not going to update. And now we've got the bottom of the megaphone and the bullish support zone all stacking in the same spot. Beyond all of the other index markets, the Dow has had the deepest of dips, and it does tend to be a dip buyers kind of market. The Dow has some really big dips, but the rip afterward can be nuts. And the fact that we're at the low of a possible megaphone gives us some clues that, hey, the bulls have a shot here. The thing is, we're not seeing any movement that actually confirms its way up. So all of this previous support kind of becomes null and void, where we're looking for a bit more than that. There we go. After a quick little modification, that's the only adjustment that needs to happen. We just got to zoom out a little bit further and realize, well, if the sellers are going to get this to continue down, and it happens in a sense where the bulls do get a pop up, they're going to be looking for a better price. They're not going to want to sell way the heck down here. It's already had an incredible move down. So realistically, then, the top of the megaphone up in this band of resistance, that's going to be the hot spot, and that is a really, really far distance away from where the market is now. At the moment, this thing is just getting buried into the floor with a descending wedge. And as long as that's the case, the bears are in control, we are in a nice zone of support. So just like all of the other index markets, we've got to get through the lows. And if they can churn through the base of that support, they've got a really good shot at making a run back down towards the lows. And with the Dow, 30,000, big psychological level, not too far away. Gold last week, I was looking for basically any pullback, and the thing stiffed me. I didn't get a single pullback, not one, nowhere even close to the areas of interest. Obviously, the market is still screaming to the upside, but in terms of the overall channel, we've kind of deviated away a bit. We've got to remodify. Quick little bump and a move here and a copy paste there, and we've got ourselves a little bit of a wider channel to work with. The overall structure is basically the same, and the nice thing is we haven't made it to the top of the channel, so there's still time for a pullback. I know it doesn't feel like it, but there is still time for a pullback. All hope is not lost yet, as long as the FOMO buyers don't kick it up too hard here. Obviously, gold is sitting right on top of 1900. The major first zone of pullback interest would be at the midline of the wider channel, and it'll be back at 1862.5, where the market previously kind of broke away from. Depending on when the thing gets there, though, we might have the channel lining up in a couple different spots. We've got the previous area where the sellers tried to get back over and they didn't get anything accomplished. They're going to be looking to get out at 1842.2. If that happens over here, then that would be a really nice zone of support. That's a long ways away, obviously. If it does pull back a bit more aggressively, though, then more likely than not, we've got our area of support buyers for swings down in the 1820s to 11s. Much more interesting down there towards the channel lows. On crude oil, we finally did get a nice little pullback here down to the 89.26s for the bulls to redefend and kick back up, even working its way through, making it down to the 87.41 area of support. Couldn't quite get it down to those 85.57s, but really the big thing that we're seeing here, and these levels aren't going to change, really. They're going to continue as we go further forward. Really, this comes down to just buyers finally getting a dip. The last dip that they had was back here on, the 24th of January. This is the last time that they've actually had anything of substance. The rest of it's just been pinned to the ceiling. So given that there's been not very many pullbacks, buyers are going to be looking for anything they can get their hands on. And if we compare this to the last pullback from top to bottom, and we look at it from a measured move perspective in terms of distance, we can see that it lines up almost perfectly with a measured move pullback. That wasn't straight at all. Let's try that again. Very, very nice support off of that. And again, we can see all that's happening is effectively they've been given a dip finally, and they're using it as an opportunity to buy in. We are going to have some resistance to work with. Obviously, there are going to be some buyers who've been buying along the way who, they haven't done very well, and now they're kind of underwater. But it seems like if they were in anywhere otherwise, they didn't get too stuck. Now their POC's down here. Everything is shifting to suggest that the bulls are gaining some momentum. And, even if there is a bearish day or a pullback day, it's more likely going to be over here after a couple days up. It just seems like crude oil is gaining a lot of momentum. The zones of support haven't changed. They've finally been given a dip. The only thing that could really throw this thing for a loop is all of the Russian news and OPEC this and everybody that. Oil is a little bit up in the air right now because of that. But all of the global stuff aside, there's some pretty good support coming in. And then finally, over on Bitcoin, Bitcoin did end up showing up with a beautiful amount of resistance off the 44,433s. In terms of support, though, nobody home at the 41,000s, just totally obliterated it. Not a soul to be found. We have dipped down to the 38,714s. That's the next area of support, but we're not really finding much here either. At least the market's pausing, I guess, but that's kind of the same thing that happened last time around. And this sort of begs the question, are we still waiting for those big dip buyers? The dip buyers in terms of risk reward, where they really gain the edge, doesn't happen until at least 37,000 to 35,800. Otherwise, the risk comparative to the upside just isn't worth it. Down here at 37,000 with a top at 70,000, you've got about a 1-to-1. You're close. Where we are above that, though, it's a bit more challenging. Not to say that Bitcoin can't go up to 100,000 or a million or whatever, but we've got to look at it realistically, and we don't have the edge tilted in the bull's favor until down here from the bigger perspective. And it seems like, given no support here and almost nothing here, it's kind of what they're hunting for. I'll tell you one thing, though. I'm going to have to wait a little bit here to see some secondary bouncing or something to prove it, because this thing is dropping like a rock. Now remember, if you aren't sure what's going on or how we're finding these major turning points and zones of interest in the market, you can check out the Day Trading Academy over on SSFTG. It's loaded with almost 20 hours of video course material, so you know exactly how to approach the markets and why they're doing what they're doing. We also build a game plan every single morning with YouTube members at 9 a.m. ahead of the New York Stock Exchange Open, so click the join button below the stream for more info. But that's going to do it for this one. If you're looking for a way to hang out with me and trade with the rest of the VIP crew, you can sign up for a 1-week trial for the live trade room right on the main page of ssftg.com, and you get our free 24-page guide and risk reward just for signing up. Nice little perk. I hope you're having an amazing weekend, and I hope you have a fantastic week ahead. Stick to those plans. Stay safe out there, my friends. Until the next one, thanks for watching, and we'll see you all then. Bye.